One rental at a time YouTube channel is different because we bring on experts from across the country in lots of different areas. We have the one and only Jonathan from Convoy Home Loans. How you doing, buddy?
I'm all right. How are you?
I'm doing well. Actually, you know what? I just realized I don't actually know your official title. What does it say on your business cards?
Principal and COO.
So,
Yeah.
owner of the company.
Yeah. One of the owners. Yeah.
Yeah, one of the owners. Okay, I'm just checking. I thought this was what it was, but I didn't know.
Yeah. Yeah.
I want to ask you just some basic, I don't know what you would call this, mortgage or mortgage market questions. And you can feel free to answer how you want. You ready?
Yep.
So if I was a homeowner, right? So owner occupant, and I wanted to be in my home for the next 15 or 20 years, so I'm not going to be out quickly. Is it possible for me to get a 30-year fixed rate mortgage with a 5 on it today? And if so, what are we looking for costs or points or however you quote that stuff?
Yeah. I mean, if you're doing it on a primary residence, there's, it's twofold. If you're going to do it on primary residence, absolutely, right? FHAs in the fives. Conventional, you can get it down easily to the fives, or you just do that, like a temporary buy down, have the seller pay for it, and you can bring it down to the fives from there. But if it's going to be non-owner occupied, secondary or investment, I mean, those ones, in order to get down to the fives, it's gonna be a lot of money. Even on the conventional, I mean, non-QM is, there's no fives there, but in the conventional sense, there is. You're just gonna have to pay a lot of money to get down there. So what I'm telling a lot of clients is right now, like if it works at like a 6 or 7, it's fine because you're gonna refi. I mean, we're gonna refi
Yeah,
potentially
people are planning to eventually someday.
in the next,
Someday.
yeah, in the next 5 years or so, right? Is it really worth it for you to pay, let's say, 20 grand or 15 grand to get down to a five when the payment difference is only like 150 bucks or 200 bucks?
Yeah.
So it's
Yeah.
not really that, it's the
Yeah.
value is not there, but
Yeah. If your
obviously
break even's 5 years, don't that's probably not a
it,
good idea.
exactly. And I mean, the way that we explain, the break even and how it works, if it's worth it or not, we just take
Sure.
the two payments, right? Whether on, let's say it's 5 grand or $1,000 and then $800. $1,000 being, let's say, 6%, 6.5%, $800 being like, let's say 5,875. That's a $200 difference. Let's say it costs you 10 grand to get down to the $200 difference. Then you just take the 10 grand and divide that by the dollar amount and then divide it by the number of months at 12 months, and it'll tell you how many years it'll take to recover.
Exactly.
So yeah, so that's kind of like the is it worth it type
Yeah.
conversation I have with a lot of clients. Personally speaking, and obviously I'm an investor myself, like
Yeah.
yourself, we talk about all the time. I don't think it's worth it right now to do it.
No.
But right now there's a whole rate grab, right? Everyone, because the headlines are so big, on like 5, 6, like, people are shopping or left and right being like, I want a 5, I want a 6, and they don't realize how much they're actually paying to get that
Yeah.
5 or a
You got
6.
to be careful what you ask for sometimes because you can
Yeah,
get it, but you may not like it.
exactly. So that's kind of what we're running into. You can get there. Is it really recommended? Probably not, right?
Yeah.
Unless your mortgage is gonna like over 1 million, right? Then yeah, your monthly payment's gonna be like $1,000 different a month. But then you're paying like 15 grand up front, 20 grand up front. You could just pocket that and not pay it.
Yeah.
So,
Yeah. For me, I think of the owner occupant sub 6 owner occ, that seems to be reasonable with some of the quotes I've seen. As an investor, I would really say something sub 7. But I
mhm.
think there's a point, a full interest rate difference between owner occ and investor today. And I don't see that going away. Again, we've talked about Freddie and Fannie kind of turning on investors and being very focused on owner occ. So I think that's coming. So that's where we are today in rates. This is obviously being recorded April 13th. So who knows? It could change tomorrow. But that was today's conversation.
Yeah, or even an hour from now. We don't know.
Even an hour from now,
Yeah,
exactly.
literally. But I mean, right now there's a lot of, obviously, going into the rate wise. The next question that a lot of people ask and they want is like, hey, I just want to put the least amount down.
Yeah, low down. Let's go
Yeah,
there. So
because
low down payment owner occ versus low down investor. What do you got?
because the market right now is obviously that whole California thing. The
California dream, baby.
like that thing was crazy. And it
It
went
was
out
gone in 12 days.
crazy, crazy. I mean, those were all like, obviously like FHA type loans, but my gosh, that I mean, we were kind of talking about it before we came on, but like we're talking about 100% leverage,
Yeah.
right? And people just don't understand the concept. They think, oh, I could just buy a house. Obviously, we've talked about it previously. It just drives everything up higher price wise,
Yeah.
creates an even bigger demand with no
Yeah.
supply.
Well, here's a real example. So one of my experts who works in Sacramento, Sacramento doesn't have a lot of inventory below the median, right? If people follow me on Twitter, they're seeing this data every day. But there was a house. It had 8 offers. 7 of them were California Dream.
Of course.
All of them were overpaying, doing crazy escalations. And you know what happened? The seller took the cash offer because the California Dream couldn't make up the appraisal gap.
Yeah.
But again, what I want to the money grab that California Dream happened was unhealthy.
It's
Yeah.
crazy. Crazy.
Yeah,
And I
not
mean,
good.
we're talking normal people, in case people are wondering about rate wise. It's normal FHA rates, conventional
Yeah.
rates, 5.6s, But
Nothing special. Yeah.
if my biggest thing was this, and clients always ask too, because they want down payment assistance, like all these things. So we offer that. And I mean, one of the biggest lenders like UWM just rolled out a 1% down payment. Like
I
it's
saw
like
that.
it's only up to 4,000 though, or like 2% or 4,000. So it's not that
Yeah.
much. Doesn't
It doesn't play in California, but it plays
no.
in some states.
Yeah, some states, but either way, it's kind of a crazy situation where what people don't realize is in this market, and I had a client I talked to about this yesterday. In this market, if you are paying like market price, what they're asking for, and you're kind of almost like, I don't want to say, but like kind of overpaying a little bit, right?
Yeah.
If you're paying at what they're asking for, you're kind of overpaying, because I'm still seeing properties in like San Diego and LA go a little above, and then the appraisal comes in low, so they have to cover the difference. But what people aren't realizing is, hey, if you put a low down payment, let's say the market swings, because let's say we're still like kind of
Yeah.
in the mid top, market swings and goes down 5%, which is not a humongous decrease, but it's very, very realistic in like a recessionary type environment. 5%, 10% in some places, 20% in some places. That's really bad. But, if that happens, you're underwater. And to get that 5%, 10% back, you are digging for years and years and years and years to recover that. Now you're
Yeah.
going to keep living in that place or
Yeah.
owning.
People should not stretch. Don't
Yeah,
stretch.
yeah, exactly. And just save a couple more years. There's going to be more opportunities. Or if you're going to write offers at that, then write offers like we always talk about, a great deal if you're going to live in it.
Yes.
If you're only, if you have to put 3.5% down, put an offer in 20% below market or below asking. You never know what they're going to say. But then
Yeah.
at least then you have 23.5% equity, right, built in there, where if something happens, you're still okay. You
Yeah.
can buy in the future, because remember, now conventional, you can't cash anything out until 12 months later.
Yes. Yeah.
So what do you really, what's really the benefit here? There's not really any benefit to putting that little down.
Yeah.
And so
What about low down for investors? What kind of products do you have there?
yeah, I mean, investor wise, obviously we used to have, we in the back, I think a year ago we talked about like 10%, 15% down. Now the only thing that's available for there is obviously seller carried seconds, like we've always talked
Sure.
about. Then also for investors, like bridge loans, if you're going to do rehab, it gives you more leverage. Bridge loan, fix and flip loan, hard money loan, private loan, like those, that's kind of all interchangeable. But like 12 to 24 months, like 15% down, 12.5% down, 10% down in some cases, with financing the rehab. If you don't finance the rehab, there's less leverage
Of
overall.
course. Oh yeah.
Yeah. But if you finance the rehab, you can buy a house, you can buy an investment property for like 15% down.
Okay.
So that's kind of like, that's great for a lot of people, but a lot of people that are buying that, remember the max leverage that this is how the bridge lenders and the private money lenders are kind of protecting themselves is, the maximum loan you can get is 70% of the ARV or 65% of the ARV. So you have to have some built-in equity there.
Yeah, with the lower of the two that you're going to get. Yeah.
Yeah. But if you have it there, then it's a great deal. You're writing a great deal on a great property that requires a little bit of work.
Yeah.
You do that, hold it for 3 months or 6 months or however long it takes to do it, and then you refi into a 30-year fixed. I think that's a great strategy.
Yeah, something I've never asked you, and actually you may not provide, so this may actually be a no answer. Um, do you help people do 203K loans?
We do provide it, we do offer it, but and same thing with like, because that 203K is FHA, and then they have home style ready
Right.
for a
Home
conventional.
ready or whatever.
Yeah,
Yeah.
home style, home ready. I mean, we do offer those, but a lot of it's kind of so stringent on getting rehab and such done,
Yeah.
and for those ones, it's more primary residence, but
Yeah,
also
sure. Definitely
yeah,
primary. Yeah,
yeah, but
definitely.
it's also not like the hoops you have to jump through because it's so like compact and the box is so tight. You have
It
to get a
is.
licensed GC and you have to do that. Sometimes the cost of going through those hoops is more than the actual loan is worth.
Right.
Is what I've experienced with a lot of
Sure.
my clients. It ends up not being as great because sometimes they want a GC that they can pay in cash and
Mhm.
kind of just like lower the cost, right?
Yeah.
So that if that's the case, then you want to go somewhere else, but you can't use that GC if you go the conventional or FHA way. So
Exactly.
that's the only caveat. But yeah, those are offered. We do them, but it's not as common because the hoops are just
Yeah,
too
it's
much.
the hoops. It's such a tight box.
Yeah,
Absolutely.
exactly.
Well, folks, as you can tell, Jonathan and Dustin, when he's with us most weeks, these guys really do help one rental at a time. Fans, you should be reaching out to them. I'm telling you, folks, the lending environment is changing. Please have multiple files open. Communicate. Tell them what you're trying to do. See who provides the best service, who can get the deal done. Because I promise you, there are some lenders whispering in your ear that are either wrong or can't get it done. So protect yourself. Jonathan, how can they reach out and see what's what?
Yeah, go to convoyhomeloans.com and let us know you came from Morat.
There you go. Thanks, buddy.
Thank you.